Markets made history this week. Nifty crossed into a new peak. With that, it also bought a classic pattern of rushing to buy the market, thinking that it will go out of reach. Of course, it doesn't happen that way. It gives opportunity for everyone to buy at the right time. So, after a new high, where to from here? Our markets had taken a lot of effort to cross into this new territory, in that it's also developed some kind of tiredness. We have climbed 15% from the bottom that we had in March this year. Of course, such big rallies will need some rest before they go up further. While at the same time, we don't see a big drop coming into the market. That's because when one part of the market is getting weak, there is equally number of stocks that are starting to develop strength, getting ready for the upside. When there is equal part of the market which is one part is going down, one part is going to go up, there is going to be a tug of war here before settling down and starting to go up. This fight will bring in leadership change, that is, those stocks which took the market up from the bottom from March till here will want to take some rest or probably go down, while those that are already down getting ready to go up will start coming up, and they will take the leadership to take the market up from here. It will be like how we have sun and moon in a day, a cycle. Similar kind of cycle repeats in the market also with sectors. Some sectors will go up, some sectors will come down, obviously keeping the market up. When the whole market starts getting weak, that's when it will start going down. In the current market, many sectors together have jointly taken the market up to its new peak. Sectors like automobiles, consumer durables, pharma, FMCG, infrastructure kind of sectors have participated. If we see around the country, automobiles, we don't have every city having automobile factory. Similarly, there are no FMCG manufacturing units in every city in our country. That's because these are smaller industry segments for India. Automobiles forms about 4.5% of our economy. Pharma is about 6.5%. FMCG is equally around 5%. Whereas India is strong in technology. Every household today has an engineer. I think you will agree on that. That's the way we are in technology. We are very strong in it. India's technology strength is 15% of its economy. Similarly is finance. Leave out the cities. Even when you go into your locality, in every locality you will find all the banks lined up in one street itself. Not only banks, even NBFCs are there today. Such is the power of financial services, not only in India. Financial services forms a bigger chunk of all the economies in the world. The first sector in any economy is financial services, which is about 30-35%, and for India it is technology at 15%. So these two sectors together form 50% of the market, while fortunately both these sectors did not participate in taking the market to a peak. In the current uptrend that made 15% for the whole market, automobiles made 28% gain, pharma made 20%, FMCG made 18%, while financial services contributed only close to 15%, while coming to technology, it has contributed only 12.5%. So the uniqueness of this current situation is that when the majority of the exposure in the market, that is finance and technology, have not participated well, yet the smaller sectors have managed to take our market to such a new peak. This could be possible only if these small sectors have super strength in them, and that has come because of the demand for their businesses, the huge demand for their products, which has created big sales and huge profits. Now, after having such a big growth, these companies are now fighting for energy, the energy of finance and technology. They want money to expand their businesses, and they want technology to support them to manufacture more, to help them satiate their demand for their products. This is where finance and technology is going to come to help. When we take the market, automobiles might not require a pharma industry support. Similarly, consumer durables will not require a FMCG support, whereas all the sectors together, including finance and technology, require finance and technology. That's the beauty of what is happening in the market today. By now, you would have got the pulse of what is that investment opportunity that we are talking about. Yes, it is finance and technology sectors to invest. Not only that, they are yet to give big runs, they are also having potential to go down from here. As of now, they are lying low. That gives us an opportunity to acquire more. And since we know they are going to have a big run, it gives us a huge profit potential. So, why are these two sectors having challenges now? Coming to finance, there is low credit offtake, it's just picking up. That's because companies already had unutilized capacity which they are been using now to meet their demands. Once it hits the saturation level, they have to go for expansion. We are already seeing lot of companies are announcing expansions now. Along with domestic, there are huge foreign companies setting up plants in India, which is going to bring very big credit offtake. While coming to technology, their customers have reduced their technology spend. They are concentrating more on their businesses, want to generate cash and then think about where technology is required and then go for technology spends. This has brought in lower business, margin pressure, job losses and all kind of challenges. Of course, this is not over yet. It is going to continue for some more, at least couple of months from now. That gives us an opportunity to buy these sectors as they are going low, so that we can make very good gains as they complete their top. Of course, it will take little longer time. For those who have that appetite to stay for a longer period and want to have big rewards, these are the two sectors which we can invest now. And we have already seen the potential for both these sectors. It's likely to bottom out soon, and that will help us. This bottoming out phase itself, we can invest more. Always, it's good to buy when the market is in turmoil, that is when there is fear. There is a saying, when there is blood flowing in the market, in the streets, put your hands into the blood, you will find some gems. Of course, we don't have blood flowing now. Well, it is little subtle. Still, you can, it's a flow of river, we can say. Put your hands into it, you can get some more gems. That's what we have identified in finance and technology sectors today. For this investment in this technology and finance sectors, keep a minimum of at least 3+ years. It's obvious that we will be having a minimum 50% appreciation from where we are investing. Investing itself will take minimum 6 to 9 months time. Slowly we can add, and biggest requirement for sectoral investments is exits at the right time. If we don't do that, then obviously we are going to have a pathetic outcome. So we will help in, like how we have identified the buying opportunity, similarly we will also help in identifying the top, so where we can exit and book profits. When we do this rightly, we will obviously take a bigger chunk of profits. Added this big profits to your regular investments, it will create a little more additional returns on the overall investments that you have. So if you are interested to invest into finance and IT sectors, please write to us, send a WhatsApp message or write through email. We will help you in investing into these two next hot sectors of India. Happy investing and have a great journey in the new territory. Thank you.